We're working on chapter 3. In my 14th edition, it's number 26. It's Persoft Corporation. And I put both the end of the chapter questions and a spreadsheet that I set up that has Persoft and C-Clip already in it. So both of those are out there. All right, so we've already calculated the amount that we paid for the company. So consideration given is $6 million. And it says that the book value says that the stockholders' equity of C-Clip is $2.5 million. So we have that, and we calculated that we have an excess of $3.5 million. And then they show a comparison of the book value and the fair value of the company. So it says that the patent has a book value of $140, a fair value of $2,240,000. So an additional $2.1 million needs to be allocated to that patent, and then it has a 7-year remaining life. So therefore, we have an E adjustment of $30,000 per year. And then the software, it has a book value of $60,000, a fair value of $1,260,000, so an excess of $1.2 million. It says it has a remaining life of 12 years, so that's going to be $100,000 per year. And then, of course, any remaining amount that cannot be allocated to a fair value is going to be goodwill, because remember, the definition of goodwill is the amount that a company is willing to pay, or well, that anybody is willing to pay for the amount above the fair value of the net identifiable assets. So since we calculate the fair value of the identifiable assets at $3.3 million, but the or actually at $5.8 million, and that we were willing to give an additional $200,000, so we must be purchasing, or I should say Persoft must be purchasing goodwill, or what we call blue sky. And of course, we don't amortize the goodwill. It is tested annually for impairment. So now we have that. We have our trial balance for Persoft and C-Clip as of the end of the current year, which is December of 2021. And we purchased them on January of 2019. So this is, we are doing a third year. We purchased them January 2019. So 19 would be the first year, 20, and then 21. So we are doing a third year financial statement, consolidated financial statement for this company. So this is the first one that we've done that was beyond 1 year. So this is good practice for us. All right. So remember the adjustments, SAIDE. So first adjustment is an S adjustment. Does what? Eliminates the stockholders' equity of the sub as of the beginning of the current year. So in the past, it's been the purchase date, but now that we're doing a third year, it's beginning of the current year. All right, so S adjustment. So the beginning retained earnings for the sub is $3,240,000. Down and get the common stock of the sub, which is $800,000, and no additional paid in capital. So our book value of the sub is $4,040,000, and we're going to credit that to the investment account. That our book value at the purchase date was $2.5 million. So it's changed. And remember that the parent has 3 different methods that they could use for accounting for the investment account. Remember what they are?
Equity, partial equity.
Initial value. Good. Equity, partial equity, initial value. So we can tell by the fact that the investment account has changed, because remember, if it were initial value, what would be in the investment account right now?
The same amount as the book value?
Like $6 million, well, the purchase price. Yep. So which would be the fair value of the assets. So $6 million would be in the investment account if the parent was using the initial investment. So So since it's 7,165,000, we know they're not using that. They're either using equity method or partial equity method. I don't think they tell us. Well, what's another way we could tell whether it's equity method or partial equity method?
Wasn't there eye adjustment?
The eye adjustment's going to be different, which means that what's the eye adjustment going to take care of? What accounts? That would be initial value method. The income of the sub, which goes in what account? If we're using equity or partial equity? Equity and sub earnings. Equity and sub earnings. So whatever that account has in it, let's see what it has in it. 575,000. So if we look at the net profit of the sub, it's how much? $975,000. So we can tell if it were the partial equity method, it would have gone up by 975. But since it only went up for 575, that's the $400,000 of additional expense. The 300,000 plus the 100,000. So that's why it's 575,000, which means they're using full equity method. Okay, does that make sense? Because the only difference between partial equity and full equity is that the parent would not record that additional expense of the allocation of the assets. They would record just the net income of the sub as a debit to investment account, but they would not do the E adjustment. Okay, so we can tell that they're using full equity method, so it's not going to change our entries. Okay, so we got that finished. So next adjustment is what?
Your A entry.
A entry, which is
Alex, the fair value of the subs asset.
as of. Good. So it allocates the fair value of the subs assets as of the beginning of the current year. So our A adjustment, if we go up here and look at our original A adjustment, so it's going to be the $2.1 million, but it's going to be amortized $300,000 a year. And then the software is going to be 1.2, but it's got to be amortized. Move this guy over. All right, so I'm going to come over here and calculate my A adjustment. You can see that, right? Yes. Okay. So my A adjustment is going to be the original allocation, but adjusted for, so this is, excuse me, the third year of since the consolidation. So I want the A adjustment to be beginning of the current year. So beginning of 2021, end of 2020. So we bought them in 19. So it would be amortized 19 and 20. So we want 2 years of amortization. So our A adjustment is going to be the $2.1 million, but subtracting 2 years. Whoops. So that's what, $1.5 million for 300,000. And then the software is going to be $1 million, right?
Mm-hmm.
Enough zeros. Okay, so that's my A adjustment. And then of course the goodwill stays the same unless it's been impaired. And it says that there was no impairment. Okay, so our A adjustment then is going to be patent goes up by, what did I say? $1.5 million. The computer software goes up by $1 million. And goodwill is $200,000. And all that gets credited to the investment account. Okay, then what's next?
Your day adjustment?
Up, SAIDE.
Yeah.
I adjustment. Well, we could do the I before the D, wouldn't be a biggie, but it's said E. So I like to say it that way. Anyway, so I adjustment would be what? What does it do? Eliminates
Okay.
income of the sub, okay, the accrued income of the sub. So in this case, since they're using full equity method, the income account is the equity and sub earnings. So we have to eliminate that. So we're going to debit equity and sub and credit what? Under equity method, where did it go when we recorded it? In the investment account. So we're going to credit the investment account. Okay. And then what?
Your day adjustment?
The adjustment, what does it do?
Allocates the dividend of the sub?
Eliminates the dividends of the sub. Good. And of course, it's for the year. So the I adjustment was not as of, it's for the year because that's the income that was earned this year. Okay, so the D adjustment's good.
Amortization, since it's been 30 years, what do we do at 30 years?
Mhm.
Because this is the end of, we only did it for 2 years.
But what adjustment is that?
And
Nope.
Mhm.
Oh, now the A is as of the beginning of the current year. So that's 2 years. Okay, and then where am I going to put this D adjustment? Where'd it go when we recorded it under equity method?
equity.
Nope. Where did the adjustment go? Equity method of the parent,
And
What-
the investment.
investment account. So we're going to put it back into the investment account. Okay, and then what? E, okay,
It's the expenses of the sub.
good. So what, well, it's expenses, the A adjustment. How do we say that? So it is the additional amortization as a result of the A adjustment. It's that $400,000, the additional expense related to the A adjustment. Only way I know how to say that. Okay, so what do we have? We got 300,000 in amortization and 100,000 in software. And I think we put that also to amortization. Do they want the depreciation to amortization? Yeah. Or so it's all amortization. Since it's software, they're both intangibles. So debit amortization expense and credit the assets. Just like we would if we were, if it was equipment, it would be debit depreciation, credit the asset. So just the same way we would record. And of course, it's the net asset. It would be accumulated amortization or accumulated depreciation. So the patent is going to get the adjustment of 300,000. And the software is going to get amortization of 100,000. Okay. All right, and that's all we have. So our investment account should be 0 at this point. And it is. And then now all we have to do is combine. So combine the revenues and all the expenses. Of course, we have to account for the additional expenses that we recorded. Okay, so and then we calculate our net income. And that'll be important when we start doing non-controlling interest, that we need to calculate our net income up at the top, not carrying it across, but you calculate from the top and you carry it down. And then we calculate our retained earnings. So beginning retained earnings, of course, we eliminated the sub. And then notice it says net income from above. So we're gonna pull that 1.3 from above. Don't go across, pull it from above. And then our dividends, of course, is just gonna be the parent's dividends. And then calculate your ending retained earnings. Oops. Okay, and then we combine our assets. Those assets. And of course, notice that the computer software, we put the E-adjustment on the same line with the software, so that's net of amortization. Same thing when we're doing equipment, we put it net of amortization. Equipment. So there's our total assets. H to H29. And then liabilities. Common stock. So it's just going to be, and of course, the retained earnings, we calculated our consolidated retained earnings, so we want to pull it from the top. Always pull it from the top. Uh-oh, we're at a balance 100,000. I've made an error. Oh, my goodwill. It had beginning goodwill. So that means that this parent has purchased other goodwill. It has purchased other companies. Okay? And so I'm in balance. That's our consolidated worksheet.